Hey everybody, Mark Yagi here. I'm going to talk about another covered call strategy, but this time for smaller accounts. And I'll tell you why. I got a comment in one of the videos. And by the way, I love good quality constructive comments because we're all trying to learn here. But I got this really great comment from a guy that's been following me for a while. We've never met, but his name is Mickey Visco. And he says, Mark, solid video as always. Since many people follow Apple and you utilize this many times in your videos, any thought for the next year making a weekly video for smaller accounts that follow you, like 200 shares and 2 contracts or something like that? You know what? Great suggestion, Mickey. And by the way, thanks for your support, and I appreciate your being on the channel. And I think that's a great opportunity for me to just kind of say, I'm not sure I'm going to be able to do this for the next year on Apple, but I've been in and out of Apple this year, and it's been profitable for me. Why? Mostly I've sold in the money. I'm an in-the-money guy. I do in-the-money covered calls. I make income. And I want to show you what you're seeing on your screen right now. Look at this chart. From 260 all the way down to below 180. And right now it's sitting below 200. Okay? So I've made money on this stock. I haven't been in it the whole time, to be honest. I was in it for a few weeks early part of the year. Then I got out and then I got back in the second, like in the last couple months. And then I got out because I'm moving brokerage firms. But look at this chart. It's horrible. It's horrible. And I was able to make money because I was in the money. So when you're in the money, the intrinsic value protects you. Why does it protect you? That's a big question people ask. It's because let's say you're in the money by $5. If the stock goes down $5, the in the money short call that you sold will go up in value by $5. In other words, it goes down. And when you're short something, you make money when it goes down. So you gain value when it goes down. You lose value on your base position, the $5. So those two offset. And so if you can strip out the intrinsic value and the extrinsic value is the juice, it's the income we're trading for, that's what's left. And so the base position is offset to the extent that you're in the money on the short position. It's just math. So if you don't believe me, just sit down with a calculator, figure out how much juice you're getting, extrinsic and intrinsic, at the beginning of the week, and how much is in the money amount. And then at the end of the week, figure out how much juice is left. Very, very little, about probably a nickel or 0 if you let it expire. And if the stock had any in the money amount, that was offset by the amount that the stock went down in the money. Not hard to understand unless you're brand new to this. And if you're brand new to this, I want to show you how to take a small account and turn it into something good. Let's look at the Apple you're seeing on the screen. And I want to just point out a couple things. This 260 all the way down to like 210. I think it's right about there. Yeah, something like that, 219. And then we had this little drop, okay? Then we had this 250 down to here to 208. Then we had this 225 down to here. But now, look at these drops are getting smaller, okay? That's what we call a volatility contraction pattern. In other words, if you connect the bottoms of these and the tops of these, you can see you kind of get a little pennant flag, right? And what that basically is doing is squeezing this stock to move to the upside, the way I see it, okay? I'm not Nostradamus. I have no idea if it's going up or down, and my crystal ball is perennially in the shop. So all I do is try to use patterns to give myself a little probability edge. And I also use the juice, which is selling covered calls, to give myself another little bit of an edge. But this is the way I see Apple right now, okay? So you can look at Apple today, or that was yesterday, whatever. We'll go to today. I don't care. Oh, it is today. And you'll see that Apple, 197. It really doesn't matter what it's at. The point is, it looks like it's in a downward trajectory. It goes down, it tries to recover, it goes down, it tries to recover, it goes down, it tries to recover. But now the recovers, the downs are getting smaller, and the recoveries seem to me to be getting a little bit stronger. So we haven't seen a lot of new lows lately, and that's because the market's green. And so we're probably getting a little bit of a support here to Apple. Now, I don't like buying stocks when they're down, but Mickey said, let's buy some Apple. So you know what? Let's make it work. I think that's kind of a fun challenge. So that's how I look at the chart. The fundamentals are really good on Apple. I mean, $6.13 in earnings to $6.75 last year to $7.17 to $7.78. I mean, that's not setting the world on fire, but it ain't bad, So Apple's doing okay. Fundamentally, technically, it's still in a breakdown, but I think like now we're able to maybe. I'm not a bottom fisherman, right? But maybe we're catching a bottom here. I'm only doing Apple because Mickey said so. All right. So let's take a look at that. Let's say we bought 200 shares of Apple at 197.01. That's what, 40 grand? So maybe that's a small account to you, maybe it's a big account to you, but I'm just going to be speaking in that level, about $50,000 and under. And so you got $40,000 invested. If you stay till the end, I'm going to show you how to do it for even less money invested and maybe get more return out of it. But let's just stick with this strategy right now. What I'm going to show you here is the options on it, okay? Now, for those of you who are new, I'll just remind everybody that an option is the right. When you buy an option, you have the right, but not the obligation, to get a stock at a predetermined price before a predetermined date. Okay. Let's say Apple's at 196.76, which is what it's showing on the screen right now. And I think Apple's going to 200. I could go here and say, I want to buy the $200 strike price for next week, and I'm going to pay $1.83 for it. You see that $1.83 right there? I'm going to spend $183 a contract. One contract is 100 shares. So I'm going to spend $183 per contract for the right to buy 100 shares, okay, at 200. Well, what could happen? Let's say the stock goes to 210, okay? It goes up to 210. Well, the in-the-money amount, the intrinsic value of that option is going to be $10. It will be in the money by $10. That's why it's called intrinsic value, in the money amount. So it'll be worth $10. So you take this $1.86 or $1.83 or whatever we just said, and it turns into $10. That's huge leverage. If you invest a lot of money as a buyer of an option, you get huge leverage. So everybody's trying to get rich buying options for a very small amount. The problem is, you got to be Nostradamus. You got to know that Apple is going to go up, from 197 to 210 in the next 5 trading days. Like, you got to know that, 5 or 6 trading days. So, but we don't know that. Like, we think we know. We think Apple's doing great, but everybody else that was looking at that lousy chart thinks it was going up too, right? There's a buyer for every seller. And so you're wrong 80% of the time as an option buyer. That's kind of a statistic that we use out there in the options business, that option buyers lose their money 80% of the time. What about option sellers? Option sellers limit themselves. They limit the upside. So if you wanted to buy these $200 options, okay, and the stock went to 200, great. You'll probably lose $1.81 if it goes just to 200. It needs to go to $201.81 for you to break even. But if you're the seller selling the option to the buyer, and you pick up this $1.85 in options, right? You get it no matter what, whether the stock goes up or whether the stock goes down. Now, you own the stock. That's why it's called a covered call. You own the stock. You own the base position. So that means that even if it doesn't go anywhere, you keep the $1.83 or $1.84 in this case, right? So you could sit there without any talent, and you can get $1.83 every week. $183 a week for every contract that you have, or for every Apple 100 shares that you have, right? So if you have 1,000 shares, you end up making $1,800 a week on a stock that just kind of sits there, right? Does that make sense? Now, what could happen? Well, the stock could go down. Well, if you're owning Apple anyway, you know that the stock could go down. It's not like you're guaranteeing anything. If the stock goes down to 190, you got a stock that's worth 190, but you got $1.85 against it. So that offsets the basis in your cost. If the stock goes to 210, well, you have to give up your stock at 200, and the person that bought the option gets to exercise it at 200 and sell it at 210. He makes the $10 because he took the risk. You got the $1.83. You took a little risk to tie up your shares and promise it to them. The stock can go up to a bazillion, right? And you're not going to lose any more money than if it goes to 200. Your limit stops at 200, okay? So you would buy the stock. You would sell the option. In this case, the 200s are out of the money. So we'd sell the option and we pick up $1.83, okay? And if the stock doesn't do anything, and we can go back and look at Apple again, it doesn't do anything, you pick up $1.83. If it goes down, you pick up $1.83. If it goes up, you pick up $1.83. If it goes up, though, you have to use some of your working capital to buy it higher if you want to stay in it, or you just let it go. They take your stock, they exercise against you or assign your shares. You end up with cash on Monday morning after next Friday, and you made your maximum profit. It's not that hard to do. Make sense? So in this case, with Apple right now trading, let's see where it's trading. We've got it at 196.66. Well, I probably wouldn't do the 200 calls, okay? But let me tell you what happens if you did, and you did this over and over and over again every week, right? Every 7 days, this expires, and you do it over and over again, and it goes up, to 200. You would make 129% return, okay? Return. Now, most people struggle to get 10% return. In this case, a lot of things have to happen, and you can end up making 128%. But what if you sold in the money, okay? What if instead of doing these 200s, you did the 190s? Instead of getting $2.78 in juice, that's the income we're going for, that's the extrinsic value, we end up getting at 190 $1.13 or $113 a contract. We've got an 80% chance of that happening, of it selling, of expiring in the money, which means you have an 80% chance of making money on this trade because you're giving yourself downside cushion. You would buy the stock or buy the base position. You would turn around and sell the option for $8 roughly in this case. $1.15 of that is extrinsic value. That's the income. That's the juice. That's what we're in this for. Okay? And the chances are this stock doesn't go below 190, right? It's got an 80% chance of not going below 190. I like those odds. Okay, that's what the delta is, by the way. It kind of gives you the chance of staying in the money, let's say. So that's pretty good. And you get this cushion because remember, you sold it for $8. You have $8 worth of cushion. If this stock goes down from 196.77 to 189.77, you got that cushion in there. 188 actually. That's a pretty good deal. That's why I like in the money stuff. But you know what? I'm going to talk about the stuff that everybody else talks about, the out of the money. So let's say you just wanted to own your Apple and not really have much to do with it all the time, and you just wanted to collect a little income. You could sell out of the money. And so you would sell these 200s for, roughly $1.73, $1.74, $1.75. But what if you don't have that much money to dedicate to this position? What if you have a smaller account? Well, what you can do is you can do a synthetic. Now, before I introduce the concept of synthetics to you, I want you to understand that they have risk because they're a leveraged instrument. What you're doing is you're replacing the base position, your stock position, which in theory has a delta of 1, right? It moves exactly with the stock, and I'll introduce delta in a second. And you're replacing it with a cheaper alternative that still controls the same amount of shares. So instead of buying the stock for $197, you're buying shares in the money that are a lot cheaper, but still allow you to be able to sell against them to create the income. So if you don't have the 40 grand to buy 200 shares, here's a better way to do it, or another way to do it. Let me finish this up by saying, look, it's risky to be in synthetics. Okay, it's risky because if the stock continues to go down and it starts to threaten your strike price, if it goes down below your strike price and it expires, you lose it all. So don't think this is like really easy because there's a risk of the stock going down. With the stock, at least you own the stock. At least Apple's going to still be churning out phones and earbuds and all the other stuff that they do. But if you own an option and it expires, you're done. So don't do synthetics unless you know what you're doing. Don't do synthetics unless you have a trading plan. Don't do synthetics unless you understand where to adjust and how to adjust and what conditions. And don't do synthetics unless you understand the market, because the market plays a big role in this. We start getting a bear market, stuff starts to go down pretty quick. And if you have a synthetic, you got to react and know how to react quickly. That being said, you now know that there's a lot of risks with them, but when there's risks, there's always rewards. In this case, you can control the same amount of Apple for a third of the price or so. Let's take a look, okay? So we've got these options that are expiring in 7 days. Those are the short ones. So what we want to do is we want to go out maybe 3 or 4 months, let's say. Let's go out to these Octobers. And we're going to try to find an option that it's a 0.9 delta. Well, there's a 0.9 delta right there. What does that mean? Well, the 0.9 delta when we're long tells us that the option is going to move about 90% of the amount that the stock moves. If the stock goes up $10, this option is going to go up by $9. You understand? If it goes up by $1, this option is going to go up by 90 cents. Same thing if it goes down. If it goes down by $10, you're only going to lose $9, right? In theory. Okay? So what you're going to do in this case is we're going to buy this option for $50.95. That's the ask price. That's what they're asking. So we would buy 2 of these contracts, okay? Each contract is going to cost us about $5,100. So we're going to do 2 of those. That's about 10 grand. That's a heck of a lot cheaper than 40 to buy 200 shares, isn't it? So you could end up buying 3 times the amount, right? So that's 10, 20, 30. You can buy 4 times the amount in this case. And you still control the same amount of Apple if you only spend $10,000. But if you spend $40,000, the same amount, you end up controlling 2, 4, 6, 800 shares of Apple. And at 800 shares of Apple, you can get a lot more juice every week. But let's just stick with apples and apples comparison. No pun intended. Pun intended. Okay. So what you do is you go out there and you buy for $50.80 one of these contracts. Okay. That's per share, but it's $50.80 for 100 contracts. Okay. So you're going to buy 2 of these contracts. It's going to cost you $10,200, let's say. Okay. You're going to go back here, and with your $10,200, you're going to sell 2 contracts. And we're going to go here at the 200s and pick up $1.62. So we're going to be picking up $320 something for 2 contracts. So doing the math, you're going to end up making 3.14% for the week. 3.14% for the week. And that's if the stock doesn't do anything. If the stock goes up from 196.06, which is where it is now, right, to 200, you're going to make an extra $4-ish times the delta, 0.9. So you'll make about $370 or something like that. And so you got another $600 coming in. But forget about that. We're in this for the juice. We're not in this to try to make money on the ups and downs of Apple. That's a different trading strategy. We're here for income, okay? That's what I teach, because income, if you get it every week, it compounds. And those little tiny bits compound on top of each other, and pretty soon you got a big tiny bit, right? And that account is growing with cash flow. One more thing I'll tell you about Apple. This is something I love to talk about, because if you look at Apple, see it right here at 196, 197, and I draw this little green line. It goes all the way across the screen. Look at where it touches. It touches back here at 196, right there. Well, what's the date on that? Well, that's August of 2024. That's almost a year ago, okay? And it also touches it here, which is June of 2024, which is a year ago. So in a year, this stock is at exactly the same price. Yes, it's gone up and down and down and up, and it's done all of its gyrations. But if you held the stock for exactly a year, you would be sitting here with 0. But if you can collect 1, 2, 3%, like I just showed you on the synthetic, or 1% on the stock, like you're making 50% a year. Does that make sense? I mean, to me, it's like a no-brainer. Now, there's lots of risks with this. Most of the risks are to the downside, especially with synthetics. Because if the stock goes down and starts to threaten your strike price, you're in a little bit of trouble. You're in a lot of trouble, okay? But if the stock goes up and it goes over your strike price, you're making max profit. If you don't believe me, just do the math. I already kind of did it before and said if you went up $10, who's making the money? Well, you're not making the money over $200. You sold at $200. You gave up your rights, right? So in this case, we make 3.14%. I think that's pretty darn good on a stock like Apple that basically is doing nothing except basically going down since January. 260, the high was, day after Christmas of 2024, it was 260, and now it's at 197. And so you could sit here and make 1% a week. Yes, the stock could go down, but notice when stocks go down, they also come back up. If you think Apple's going to be out of business, don't even bother with this one, right? If you think Apple's going to be in business in 2, 3, 4 years, well, you could just do this for the next 2, 3, 4 years. If you make 1% a week, and that's what we teach people to do. You make 1% a week. That's all. 1 to 2 we say, but let's say you only make 1. That's 50% a year. In juice, whether the stock goes up, down, or sideways. So, I'm not saying it's perfect. I'm not saying you're going to make money every time, but I think it's a lot better than just sitting there like a dope and just looking at your screen for a year, like some of these people that bought it and rode it all the way up to 260. Most people didn't exit at 260. They're still holding it in their mutual fund and their account because they believe, like you probably believe, that Apple's going to be around. Problem is they didn't get any juice for the last year, and they're back at exactly the same price as it was a year ago. Why do that? Why not get a little bit of juice on it as it goes sideways or goes up or goes down? All right, I hope that's making sense. And that's how you could take a small $40,000 and just make, $300 a week on it, which is not great. It's not bad. It's whatever you think it is. Okay? $1,500 a month seems like good money to me on a $40,000 investment. But if you add synthetics to it, now you're making 3%. What if you turn that same $40,000 and you did 8 contracts? Now your amount of money is increasing. Okay? And that's making you a lot more money than just the $360, right? You multiply that by 4. Now you're talking about $1,200 a week. That's almost $5,000 a month on a small account. There are risks. I want you to understand that there are risks. This is not a sit back and set it and forget it system. This is, it's going to take a little bit of work. If you can click a mouse, that's the work we're talking. We're not talking about digging ditches. We're talking about clicking a mouse and thinking, using your brain to make a little bit of money out of a small account. All right, Mickey, thanks for your comment. I hope this helps you all just to take a stable stock like Apple and show you how to make reliable income from the juice. See you next time. Hey, it's Mark Yagi, and if you haven't subscribed to this channel, please do that right now. That would be a great favor to me, and plus it helps me get this material out to a lot of other people that might need it. I've got a little bit of a movement going on here, and I want to try to change the world one person at a time, showing them that you can make safe, reliable income from the stock market. And plus it helps to grow the channel a little bit. Also, if you would give me a thumbs up on the video and like it, great. If you don't like it, give me a thumbs down, that's cool. But just tell me why you don't like it so I can get better. And then hit the notification bell so you can get these videos as soon as they come out, because a lot of times this is timely information and you want to get that information before it gets stale. The last thing is to join my free Insider Tips newsletter. There's a link below and you get everything in one spot. You get breaking news and analysis also. So that would be great if you could do that too. See you soon.